Lifestyle Series. I'm your host, Travis Watts, the Director of Investor Education here at Ashcroft Capital. In today's episode, what we're talking about is how to avoid the top 3 investment hurdles. Disclaimers, as always, never financial advice, not telling you or anyone else what to do. These episodes are intended to be educational and informational purposes only. With that top of mind, I want to go ahead and dive right in, but first I just want to clarify what an investment hurdle is. And it's what I've seen so many investors do over the years. And quite frankly, it's what I've done throughout my journey. And I want to help you avoid these mistakes or these hurdles. So without further ado, I'm going to dive right in with number 1, and that is timing the market. It can be very difficult to figure out when is the best time to get into the market, or for that matter, when should you get out of the market. And here's the deal, you guys. Nearly every time I've tried to time the market throughout my investment journey, I have been proven wrong. There was a home that I sold in 2016 in Denver, Colorado, $600,000. And I told my wife, this is the top of the market. This is it. We're going to max out, get max profits, and move on and invest our money, just to watch that same home go on to become $750,000 over the next few years. I could not accurately time the top in that case. Another example, a buddy of mine convinced me to invest in a crypto mining company, publicly traded, and it had fallen 50% from its all-time highs. And I thought, if you look back at stock market history, a 50% decline is pretty significant. I'm going to get in because I'm going to scoop this thing up at a discount, only to watch this stock continue to fall another 30% from the time that I bought in. We're still waiting to see the ultimate outcome of that one. Last example, there was a year that I sat on the sidelines for about 6 months, just waiting on that perfect deal and opportunity, just to give up about 6% annualized yield in other investments I could have made earlier in the year. So the solution that has made all the difference for me, the thing that I keep turning back to nowadays, is that time in the market beats timing the market. So stay focused on the long term. Number 2 is lack of time, education, or expertise. I can't tell you how many investors I've spoken to over the years that believe that they need to be the experts. They need to know everything before they decide to go ahead and get started with an investment. What that often leads to is analysis by paralysis. You get caught up in all these blogs and articles and podcasts and books and mentorships and masterminds to where you don't end up taking action because you're just trying to fill in all the blanks. And I'll start with the good news here, and that's that there's all types of investments out there for all different types of people at all different stages of life. And I'd be willing to bet that there's a few that may be appropriate for you. I remember back to, I did the first 6.5 years of my investing journey doing everything myself with single family homes. I was trying to flip and do vacation rentals and do all these renovations, when I had to look myself in the mirror one day and just say, look, you're truly not the expert. You don't have the formal training, the expertise, the connections. You're not a handyman. What are you doing? And that was at the point in my journey where I decided I'm going to start partnering with people and investment firms who are the experts in the industry, who do have the proper training, that really can do a lot better, quite frankly, than I can do. And this is the classic example of what a real estate syndication is, which is the majority of what I invest in today. And it's where the limited partners, which is what I am, can rely on a general partner or an investment firm to find these properties and underwrite them and renovate them and essentially execute the business plan on your behalf so that you can kick back and share in any potential profits that that property may generate. So the takeaway here is that sometimes the best knowledge is simply knowing that an option exists for you. And that brings us to number 3, which is the fear of losing money or the fear of losing everything. And you guys, throughout my journey, I can tell you there's really just one thing I've found to circumvent this fear, and that is diversification. So most assets go in market cycles between expansion and contraction. The economy goes through cycles of expansion and contraction. So knowing this can first and foremost give you some perspective and peace of mind, knowing that it's not if, but rather when. Now, we already discussed trying to time the market and how that's really difficult for most people to do. But what we can do is diversify in different asset types that have different business plans that are located in different geographical regions and among different types of sponsors or general partners in the case of syndication. So, that right there is four different ways to diversify all within real estate, let's say. And we haven't even discussed stocks, bonds, gold and silver, oil and gas. There's four more ways to diversify outside of real estate right there. And I want to leave you guys with one additional consideration, and that is dollar cost averaging. See, I'm the type of investor that invests primarily in the real estate sector. Not saying it's right for everyone or right for you, but it's right for me because it's what I know and understand the best. And I found it to be a very favorable asset class through down cycles, stagnant markets, and uptrending markets as well. Now, as you're well aware, over the last year and a half, interest rates have increased dramatically at the fastest pace that we've ever seen in history. Have you ever heard the saying that the bull takes the stairs and the bear jumps out the window? What that refers to is how markets typically behave. In other words, a bull market, which is an uptrending market, takes many years in most cases to build up. It incrementally rises. But when recessions come and when the market shifts on us, it usually comes fast and it comes quick. And that's symbolic of the bear market, or the bear, in this case, jumping out the window. So to bring this analogy home, I've been investing in real estate year over year. And every year I've been paying incrementally more for the same type of real estate than I otherwise would have paid the year prior. And this takes a long time. I've been at it in the multifamily space about 8 years, and now we're in the midst of a market shifting. And so this is good news and bad news in terms of interest rates. The bad news is, due to the increase in rates so rapidly, a lot of the properties I've invested in over the last couple of years might be below the pricing that we paid for the property. So that's not good news. But the good news is that the deals that I'm investing in today in 2023, in some cases, are being purchased at a discount of 20 to 25% relative to pricing a year or two ago. So that's the classic example of being able to buy the dip, or to dollar cost average, which is getting an average price over the long run and continuing to buy in the up markets, the down markets, and the sideways markets. Something to think about here for the week. I'm Travis Watts. You're listening to the Passive Income Lifestyle Series. I hope you found some value in this short episode. If you have any questions or want to take a deeper dive on real estate private placements, passive income investing through multifamily apartments, reach out to me at travis@ashcroftcapital.com, or you can visit AVAF3 for current opportunities and offerings. Thank you so much for being here. Have a great week, and we'll see you in the next episode.